Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit adisa.org and check out the resource library. This is a podcast-only version of Focus on Alts. I'm your host, Greg Mausz, and I'm joined today by John Kent. He is the head of capital markets at Gladstone Companies. John, thanks for being here today.
Thanks for having me, Greg.
So we're going to be talking about private credit. We're going to be talking about business development companies and how they're impacting the economy and how BDCs are more important than ever to financing the economy. But then we're also going to say, kind of take this down to the advisor and investor level and how investors are really able to take advantage of financing the private markets through BDCs. So, we're going to go down this road, but why don't you kind of set the stage for us?
Sure. I think what we've seen over the past several years, you can even go back 10 years, is that in the non-traded market in particular, REITs have been dominant and they've raised gobs of capital. And interest rates have been at a good place and real estate values have been at a good place. And it's been a great market to raise capital in real estate, and there were several issuers who really paved the way for new entrants into the market. With the changes over the past few years with interest rates and with real estate values, we've really seen a reduction in the amount of capital that's been raised for REITs, and it's been a more difficult acquisition environment for REIT managers. And at the same time, you've had this confluence of events with commercial banks that have had difficulty not only with the commercial real estate sector on their balance sheets, but also with interest rates and with regulatory concerns that have caused them to pull back a bit from lending to private companies, lending in general. And that's been a place for private credit, private lenders, BDCs, any of the above to fill a hole in that void for lending. And so over the past year and a half, 2 years, private credit vehicles have eclipsed REITs in terms of capital raised and AUM, and it appears that that's going to continue for the foreseeable future. This isn't just I don't think this is just a 2023, 2024 issue. This is a cyclical thing that has happened over the decades. I think from even going back to the late 2000s and the credit crisis, banks had to pull back, and that was probably one of the BDCs have been around for a long time, but that was probably one of the events that have really caused BDCs to explode in terms of their importance to the economy and the reliance on private companies to raise capital from them.
Yeah, and from the portfolio perspective, I think that REITs and BDCs both play a role, both can add value, both provide good diversification for the individual investor. But let's focus on the companies right now, the companies that are using this money. Kind of what is the current state of financing for private companies?
Sure. I guess if we could back up for a moment on BDCs and what their regulatory requirements are in terms of companies to whom they can lend.
Sure.
They have to be U.S. firms. At least 70% of a BDC's portfolio must be of assets in private or very small, thinly traded public U.S. firms, and generally with market values less than $250 million. BDCs are required to provide some sort of managerial oversight or assistance to their portfolio companies, and this isn't necessarily related to that point, but they also have requirements on asset coverage and indebtedness on the BDC itself. So if you think about the universe of U.S. companies in a pyramid, the largest companies are going to be at the top, and there's going to be fewer and farther between those companies, and there's many, many companies who fill that base of that pyramid that are smaller, and it's harder for those companies to raise capital from commercial banks. Increasingly, it's harder. Oftentimes, those are cash flow loans; those are not asset-based loans, and it's hard for banks to get around on loans there. And the public markets for smaller companies can be very difficult, and so that has been one of the reasons why these private credit vehicles, these direct lending vehicles, have risen in importance.
Got it. So, John, thank you for walking us through that. Now, I know that BDCs invest in kind of a wide range of companies, and different BDCs kind of focus on different niches. I think y'all focus on more that lower middle market, but can you walk us through that whole kind of universe?
Sure. BDCs and direct lending vehicles in general can invest up and down the size spectrum of private companies. In general, the larger you get as a private company, the more likely you are probably to have access to other forms of capital, maybe the public markets. You might go public, you might have public equity. So you're generally going to have fewer large companies that are private, that are really the target of the direct lending market. That said, there are, when the public markets are inhospitable to new issue and companies still need to raise capital, the direct lending market can be a very efficient way for those companies to raise capital. They can there's more and more sophisticated lenders. Some of the biggest private equity and buyout shops more or less all have BDCs now and direct lending vehicles. They can execute faster than these companies could raise capital in the public market often. They can do it with greater certainty. They can do it as a sole provider of capital and not have to syndicate those loans. And so for issuers, up and down the size spectrum, those can be very interesting investors to raise capital from. And as you're a larger fund manager and private equity or buyout shop, you have more capital by definition to put to work. And so you need to really deploy hundreds of millions of dollars at a time. And you're not going to do that in very small companies. Mm-hmm. And so, as you mentioned, our companies focus on the lower middle market, and there's lots of different ways to define that, but there's a lot of companies in that market. They are generally smaller. It's harder to get bank financing for them. There are a lot of favorable traits to the lower middle market. Those companies are generally selling for lower cash flow multiples. They will have lower leverage. Oftentimes there will be less competition as a lender, and so as that lender, you're able to get more favorable terms, higher yields.
Sure.
And obviously that's a positive for the performance of that fund that is investing in the lower middle market, and as a result, and favorable oftentimes for the investors who invest in the vehicle, in the BDC or in the other private credit vehicle.
So let's unpack that some more.
Sure.
When investors are investing in BDCs, and clearly we know banks make a lot of money because they have their names on top of a lot of tall buildings. BDCs are lenders like banks. So there's a lot of money to be made there. So investors can participate in that by investing in BDCs. But what type of investor would really focus in on BDCs and adding that to our portfolio? Growth, income, tax advantages? Talk me through that.
Sure, that's a good question. It is predominantly income-oriented investors. BDCs will pay out their earnings in the form of dividends. So all BDCs that you look at will have a dividend yield attached to their stocks. If you think about banks, they are large. Increasingly, they're larger and more consolidated. And so while they will lend, they will also have other lines of business, and it's not exactly a pure play investment if you're investing in Bank of America or any of these banks. Yeah. It's not really a pure play direct lending investment for you as an investor, whereas if you were to invest in a publicly traded BDC, for example, you know that BDC has similar leverage limitations and not similar, but they have regulatory limits just like banks do, but they are strictly direct lending, and you know that they will be paying out their earnings to you in the form of monthly or quarterly dividends. There can, of course, be, depending on where you invest in the capital structure in a BDC, there can be more or less growth in the underlying investment, but really it's a retail-oriented product, and more often than not, retail investors, when they're investing in vehicles like this, they're looking for income. Like a REIT. It's very similar to a REIT in that way.
Well, and like a REIT, there's no taxation at that corporate BDC level. All of that gets passed through to the investor, so that creates a higher yield. So you mentioned traded BDCs there, but there's also non-traded BDCs, and we've seen a lot of growth in that area. Why would an investor choose a non-traded over a traded BDC as an investment?
It can really come down to an investor's risk profile and what they are seeking. Yes, we just mentioned that they are focused on yield and monthly income or quarterly income. In a non-traded BDC, while you will have that, chances are you are investing in a common stock or a common stock equivalent that you will believe is going to have some growth in it over time. If you are investing in and you will have less liquidity by definition because it's non-traded.
Right.
If you are an investor that values having liquidity when you need it, and you like the transparency of publicly traded companies, you have the option to go, to a publicly traded BDC. And the other thing about publicly traded BDCs is you would also have potentially the alternative to invest above the common stock in a preferred structure. So there are some of those out there that give you some seniority in terms of payment of dividends, and maybe some more stability in terms of the value of your investment.
Yeah. So to summarize, BDCs like REITs, they oftentimes are just more volatile because of those market dynamics on the traded side. And when you hit the non-traded side, you go back to more of an NAV calculation that drives that value versus the overall markets. So it creates that more stability.
That's true. And back to the non-traded BDC or the non-traded REIT, they do have that periodic mark, which means that their NAV will fluctuate even though they are not traded. They just may not have the wild market fluctuations that are supply-demand type influences on the stock price.
Right. John, thank you for sharing your thoughts on the private markets and BDCs and how this subsector of investing works.
My pleasure. It was great.
And thank you all for listening for another episode of Focus on Alts. Again, for more information like this, please visit adisa.org. Thank you.